Hey, welcome back to The Dive. Today on the show, we have Mike McGlone from Bloomberg. Mike's here today to share his thoughts on OPEC oil producers cutting production, a possible commodity bottom, natural gas being traded in Yuan for the first time, and what it means for the market, Bitcoin, and of course, gold. Hey, Mike, welcome back to The Dive. Thank you so much for joining us today.
Hello, Cassandra. Thanks for having me back on this Monday, April 3rd. There's some cool stuff going on.
Yes, definitely. So let's start off with the big news in oil. Saudi Arabia and other members of the OPEC oil producers announced a surprise oil production cut that will exceed 1 million barrels a day from May until the end of 2023. Where do you think the price of oil is going?
Few better ways to solidify a bear market than when you get OPEC surprise cuts. It's a bear market. The last time they did this was in October. They cut 2 million barrels, at least they said they did. That was 2% of global annual production. Now they're trying to cut 1%, and the market, the timing was impeccable. It helped spark a good short covering rally, but I think it's part of a broader, big picture bear market. OPEC is well aware that demand in risks are clearly to the downside, with most central banks still tightening, with this significant credit contraction, with bank crisis, and most indications typically tilting towards the U.S., tilting towards a significant recession starting in Q3, and that's clearly from our economics team lead Anna Wong, who's pushing it actually closer now. OPEC is part of that contracting liquidity. There's massive contraction liquidity going on. Unlike now, you look at money supplies negative, bank deposits on a year-over-year basis are the deepest negative ever. And sure, we're getting a little bounce in risk assets, a little bounce in crude oil, but I'd say good luck. I think crude oil around 80 is more likely to go to 40 than above 100 and 120. So to me, the next $40 is towards $40 a barrel, which should be just following what natural gas has done.
Do you think that there will be any geopolitical implications to the decision for the cut?
Yeah, so there's saber rattling, but I think it's more a responsible thing that a cartel does. I've been pointing out the risks for crude oil are down forever. Now, this has happened in natural gas. Natural gas has dropped 80%, drops to about its U.S. cost of production, the U.S. around 2, which in the equivalent in crude oil is around 40. And maybe OPEC's reading some of my stuff. I do have broadcast over there. We do. But I think they're very aware the greater risks for crude oil are prices plunging a lot. So yes, there's going to be saber rattling. This is somewhat of a response to the Biden administration not refilling the strategic petroleum reserve. I don't know how much that's the case, but the U.S. doesn't really need a strategic petroleum reserve anymore. With Canada included, we have a net excess of about 4 million barrels a day in liquid fuels. That includes biofuels and things. In terms of production in excess of consumption, and OPEC's dropping another 1 million. This doesn't really affect the U.S. too much. It gives us more to export at higher prices.
How might this production cut affect the everyday consumer and their daily lives?
It's a short-term thing right now. It's mostly for OPEC's clients and customers. They did say they increased their prices. Now the U.S. is a net exporter, so we're a competitor in that space. But it's a shorter-term thing. In the big picture, most consumers are still getting hit hard by inflation. CPI, PPI are still running around 6% or so. It's pretty high. They're very much lagging. Forward-looking measures are collapsing, like commodities. But it's a short-term thing. If anything, it's not good, but it's one thing that our almost economists have said, well, this is just going to make central banks more diligent to tighten rates and keep rates higher against inflation, and it's worse for consumers as everything starts to tilt downward, with exception of things like the stock market and risk assets, which I think is the next domino to tumble. The key thing that's really been declining are bond yields.
Okay, so speaking of this commodity bottom that you just talked about, we saw you tweet about it. Maybe could you shed some more light on it for us? Are we near the bottom?
No, I don't think we're anywhere close. And OPEC cutting production is actually going to make it worse, contrary to popular opinion, because they are now less than 30% of global consumption. The last time they had a really significant cut was 2008. With that plunge, they were around 40% of total global consumption. So they're relevance is declining. But I think what's happening is markets are more likely to follow lumber, which has plunged, natural gas, which has plunged, copper, which is rolling over. And I'll mention that one right away. Copper is trading almost the exact same price, the dollar price of copper, as the S&P 500 if you divide by 1,000. They're stuck around $4. And I fully expect that to go lower because we've had that bounce. The key thing to remember is the most significant central bank on the planet is still tightening, looking at lagging measures of inflation, and all the forward-looking measures are tilting downward. So I'll give you this one fact. The Bloomberg Commodity Index is down about 20% or so on a 12-month basis. In our history since 1960, that's never happened with the Fed tightening, and they just tightened last week. Was it 2 weeks ago? So I think it's still pushing the pressure lower. And I think this is, to me, everything we're hearing and seeing now is part of one of the most significant economic resets of a lifetime. And we're seeing that a little bit in the 2-year note as we speak, and the 10-year note yield. Right? As we speak right now, the 10-year note yields on the cusp of a new low for the year, around 336 or so. And the gold at the end of Q1 closed at its highest price ever. Those are trends I expect to continue. Gold going higher, yields going downward, stock market rolling over, and crude oil and commodities downward.
You mentioned natural gas. And we saw that China just completed its first trade of liquefied natural gas with France in Yuan last week. Do you think that the Petroyuan will be a regular part of oil markets in 5 years?
Could be. Well, they're one of the largest net importers, so sure, they have the right to pay for that commodity in their currency if others want to accept it. But what's going to happen with these other countries once they accept that yuan? Are they going to invest those yuan in the deepest treasury market in the world? No, it doesn't exist. Is it going to be free flow capital? No, it doesn't exist. So that's, I think, appropriate. That when the world's largest demand pull source for crude oil was the U.S., sure, we had the right to, and of course, provide security and the main currency in the planet. No one's going to dispute pricing that in dollars, but that's to me part of that natural migration that some people who are still bullish crude oil missing the fact that the U.S. is now a net exporter. We create more energy, more agriculture than any agriculture products in any country on the planet, and export quite a bit, including Canada, a great amount. So I'm not worried about that. And I think when I tilt over what's really happening with currencies, you see what cryptos have done. They've gone completely to the dollar as a base layer organically. That means, yuan and euro and other currencies do okay, but the dollar is still dominant and gaining dominance.
Do you think that this could have an impact between the French and American relations?
Sure, it could. I'm not worried about that so much. That's a pretty solid bond, and I think the French have to look out for their vested interests. But no, not really worried on that one. And that's kind of macro. It's a bit more speculative than I think it's going to matter. I don't think it really is going to hurt the dollar. And the dollar is due for a bit of a correction, but in the big picture, the dollar typically rallies versus most other fiat currencies, and that's been measured from the Federal Reserve since like the 50s. And maybe it's due for a bit of a correction as as the Fed tilts towards easing rates eventually. But there's still the deepest liquid capital and treasury markets on the planet, and nothing's even close.
Okay. So let's move on and talk about crypto for a minute. 5 days after Binance and its CEO were sued by the CFTC for alleged trading violations, a new $1 billion lawsuit was filed against the crypto exchange. Do you think that Binance will still be around in a year?
Yeah, I think they will be. But the things I've read about Binance, there's some legitimate concerns about breaking U.S. security laws, existing laws, and that I don't dig in too much. The key thing is I think the market's very much fixated on this issue, and hopefully proper rule of law and proper regulation and proper following regulation will work itself out. The key thing I look at is, does this make a difference for the supply, demand, and trajectory of prices in cryptos and Bitcoin and Ethereum? And it doesn't. You can't affect the supply of Bitcoin and Ethereum because by code they're going down. Does it increase the demand? It doesn't, I think, affect the demand so much. I think it really hurts the businesses, and certainly the businesses in the U.S., which means there'll be more of it's part of that push back from U.S. regulators since FTX on cryptos, which means a lot of the jobs and revenue and votes are going to leave the country, which means they'll come back as we're getting to a presidential, a pretty significant election cycle next year. So this to me is part of that. Part of the bump in the road of U.S. Regulation and U.S. adoption of this rapidly advancing revolutionary technology. And some people don't believe it, but I like to end with what's the most widely traded cryptos on the planet are crypto dollars. And I don't think the U.S. is going to mess that up too much.
How dependent is Bitcoin on Binance?
I don't think it's too much dependent because Bitcoin, the whole thing about that's the unique thing that's really happening with all this regulation lately. It's really pointing out the value of Bitcoin. Bitcoin's been outperforming Ethereum. It's been outperforming most other assets because it's becoming more of a global digital collateral in the world going that way and trading more like gold and long bonds and as a counterpoint to banks. But then there's 23,000 other securities, which are not securities. There are 23,000 other cryptos that are a bit dicey. So Bitcoin is the shining star. I think will continue to be that way. I'm bullish Bitcoin clearly in the long term, but in the shorter term, I'm very much concerned. We have a significant liquidity rug pull going on, and Bitcoin is one of the real riskiest assets. So I fully expect the S&P 500 around 4,000 is more likely to go to 3,000 if you just watch money supply and the bank run deposits leaving banks. There's a clear credit contraction going on. The Fed's still hiking rates. Now, Bitcoin's done well in that environment. Every asset's recovered this year, most assets, but I fully expect it's going to have a bit of a ebbing tide pull as the stock market rolls over if that base case plays out, which is still my base case.
Okay, so let's move on and talk about gold. How important is the $2,000 price level for gold? It seems to have had a hard time breaking through.
Matter of time, it breaks through there, Cassandra, and never looks back, and it just transitions to support. So at the end of Q1, the gold price was the highest ever on a quarter-end basis. That's a bull market. Right now, on a monthly basis, around 1980, it's clearly close to the highest month-end close ever if we close the month here. And I see gold in during bull market that's had a dip and it's going back to that trajectory. The opposite part of that fuel is the bearish market we see in crude oil and natural gas. They've had enduring bear markets have bounced and going back to that downward deflationary trajectory. So the key the way I look at gold is it's going to take off and run higher, particularly as I expect the Fed to pivot and the U.S. to head towards a significant recession. That's not a profound statement. That's where most indications are looking, particularly things like the yield curve. The key question is how the dollar will respond. I think most people are looking for a weaker dollar. I'm not so sure about that. But the way I look at gold is I think it's going to be one of the best performing assets this year. By the way, it already is. It's up about 9% on the year. If you look at crude oil at this point, it's unchanged. Copper is up about 6% and tilting downward. So I fully expect that trajectory to continue to accelerate unless we can avoid this recession, which I think is going to actually get worse than most people think. So the key thing is I don't think it's prudent to hold gold anymore without that new up and coming digital version taking some of that space. You have to have some Bitcoin in that space or you're probably at risk of falling behind.
At what point do you see gold producers starting to catch a bid?
That's the problem with the macro gold producers. You look at a thing like the GDX index, typically as a basket of in an index, gold producers underperform gold or the GLD, the ETF. Historically and over time, if you're looking to do well with gold producers, you have to be more tactical and pick the one or two or three that'll do well and hope to get that excess of performance versus the actual underlying metal. So I'm macro. I usually say just buy the underlying metal when you're bullish the metal, and let the miners, let the people who are more tactical and focus on the digging into the specific miners try to get that beta or that alpha versus the underlying metal. The key thing to remember is as a index, gold producers typically underperform the metal. And there's a good reason for that because it's harder and harder to create that gold. Rapidly advancing technology is not helping too much. You don't really create gold. You mine it, you find it. But it's easier and easier every day to create fossil fuels. And that's why overall, if you look at the underlying price of, say, crude oil or natural gas or any petroleums, they underperform. The actual commodity underperforms the equities, like an index that tracks an index of equities.
What is your preferred way to get exposure to the gold market?
Oh, well, the ETFs are great. I have to be careful giving investment advice, but the ETFs that track the underlying physical are simple and straightforward, and they're basically quite commoditized, and they are the most widely tracked and traded commodity ETFs. I mentioned one GLD, and there's a bunch of other ones. That's just the benchmark, but there's plenty more of them, and they track the physical, and they're quite straightforward, and they've been around for almost 20 years now.
Okay, great. Well, that's all we have for you today, Mike. Thank you so much for coming on. Before we let you go, could you let our audience know where they could go to hear more of your commentary?
Well, number one, I'm on the Bloomberg terminal. I post on LinkedIn. I'm Mike McGlone on Bloomberg. I'm happy to link in with people. I'm happy to add people to my distribution list. And on Twitter, I'm at Mike McGlone 11, and I'm happy to add people to my list. And thank you for having me.
All right. Thank you so much, Mike. We'll talk again soon. To our audience at home, thank you so much for tuning in today. We will be back again tomorrow with the latest in small cap news coverage. So if you like learning about this kind of thing, please be sure to stay tuned by hitting that notification bell and subscribing below me there before you leave us. Bye.